Hi, I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that's helpful to your understanding of the markets and also what happened this last week in the markets. And we do this from a Christian worldview, a biblical worldview, with no financial agenda. So let's talk about the 4 things we learned in the markets this week. Point number 1, this was the best week for the markets since June of this year. And hey, let's also talk about there's some generally positive weather trends across the U.S. for the weekend. So these are reasons to get happy and celebrate, right? Friday saw the markets make a big jump early thanks to some strong earnings reports. It actually nearly dipped negative, and parts of the market actually went negative in early trading, and then it jumped to the moon. The S&P 500, which for those of us that follow the Dave Ramsey style of living our financial lives, is comprised of our growth and income stocks. That ended the day up 2.37%. The tech-heavy NASDAQ, which is more of your growth stocks in the Dave Ramsey vernacular, ended the day positive 2.31%. And the Russell 2500, which is the benchmark for more aggressive small stocks, ended up 2.02%. For the week, the S&P 500 was positive 4.74, while the NASDAQ was up 5.22, and the small caps were positive about 3.36. So a great week for the markets. We'll see how this next week plays out with a lot more earnings on tap. Point number 2, I'm certainly no economist, but there are 2 main Federal Reserve models that I watch very, very closely right now. The first is the Atlanta Fed's GDP Now model, which you've heard me talk about. This gives us a forward-looking glimpse into economic activity for the quarter before it's actually even announced. It gives us what they think the GDP model is going to be, and it's been very accurate. The Cleveland Fed's Inflation Nowcast model is the other one. And it's worth mentioning that the Cleveland Fed Inflation Nowcast model is looking for a 0.8 monthly CPI inflation number for October, higher than September's 0.4% increase. And this model has been accurate in predicting the eventual outcome even 3 weeks before it's actually reported. So its predictive power has been very solid. If it's similarly accurate now, we can look forward to another choppy and unfortunately hot CPI report in November that will be those October data. However, the 2 and the 10-year Treasury yields today actually moved higher for the week, and that's a sign that the market already knows what the Cleveland Fed's Inflation Nowcast model is trying to tell us today. Point number 3, as promised last week, let's talk about the Fed funds future rate expectations. On Friday, we saw the CME Fed Watch tool, which is a great indicator for what the Fed will most likely do with interest rates, still keep their November 2nd meeting expectations at 0.75 of an increase. That would be predominantly what they've done the entire year. But the probability of them doing that in December has now dropped from a 75% probability to a 45% probability today, October 21st. Conversely, expectations around a 0.5% rate hike in December increased to 51% from 24. So it's gone down from thinking they're going to do 0.35 to 0.5%. In regards to a rate hike during the first meeting of 2023, the odds are of a 75% rate hike fell into the 13%. And to no surprise, the market exploded higher today when they heard that. Also, the San Francisco Fed president today, Mary Daly, stated that too much interest rate increases can put the economy into an unforced downturn and that we shouldn't expect 0.75 rate hikes forever. So she's the first Fed president that's actually saying something against being to the moon with interest rates. And point number 4, if you sold your home last year and sat on the sidelines to wait for the market to cool, you may be the smartest person on the face of the earth right now. U.S. existing home sales fell for an 8th straight month in September, which was the longest streak of declines in 15 years. Sales of previously owned homes dropped to a seasonally adjusted rate of 4.71 million, which is the weakest rate since May of 2020, in the height of the pandemic, basically. However, if you take out the pandemic, it was the slowest since 2012, which of course was when we were coming out of the great financial crisis, the GFC. Mortgage rates for a 30-year mortgage hit 6.94% for the week. They did top 7, but they ended 6.94, which is sidelining many buyers and decreasing the incentive for existing homeowners to upgrade, or move into a larger house. This is what the Fed is trying to do, by the way. There's no surprise here. Housing is such a big part of our economy, from our realtors to our construction folks to our mortgage brokers to the banks and the investors that buy those loans, you could technically call the U.S. housing market in a recession right now. And so certainly something that we're going to continue to watch, with housing being such an important, integral part of our economy. So those were the 4 things we learned in the markets this week. Hopefully that was helpful to you in your understanding of what's going on. If you have any questions on how the markets are impacting your particular situation, or want to talk through any of these things, certainly feel free to reach out to any of our advisors. You can go to the notes in the video to hit the link to schedule a meeting with any advisor, or you can also hit the notes to check out our blog, which has some great content, including great content we wrote this week about Treasury yields, some 2023 planning updates, and some spooky stuff around October and Halloween. So check it out. And if you like the video, please do us a favor. Help us with YouTube and Google's analogs, and smash that like button so that you can help our video get out to more people, so we can help other people live and give like no one else. Thanks so much. We'll talk to you next week.